Hello and welcome. Today is the 29th of July, and this is another episode of Two Grey Beards. Hi, Andy. So, what do you think happened last week that was of interest?
Well, last week was a lot of action with mostly expected outcomes, except for
Yeah.
the Bank of Japan. Data was basically confirms the continuing trend of strong labor market. Job numbers were very strong, and the PCE was mixed, but low. And but that's basically been the trend: declining, slowly declining inflation, still well above target, and strong growth.
Yeah. And while everyone was mesmerized looking at what the Fed would do and what the ECB would do, and they did exactly what was expected, uh, the surprise was actually the soft yield curve control abandonment from the BOJ, which we did not expect. But there you go. We got it earlier than we expected. What do you think the implications of it are?
Right. What happened is they have soft expanded the band. Now the question is, how do they behave? At some point, the yields will rise to a point where the BOJ says, we're going to buy some bonds, and they're going to buy some bonds. And,
Right.
that continues to be stimulative. It doesn't hold the line at 50 basis points on 10 years, but it allows some flexibility. And so the question is, when will they have to buy bonds? And JGBs. I put something out on Twitter on Thursday or Friday, and JGBs are actually fairly cheap even though they have a very low yield because of the extremely steep yield curve in Japan and the extremely inverted yield curve everywhere else. JGB bonds are actually, for any investor globally, swapped back to their own currency, are actually about 40 basis points cheap.
Yes.
So it's going to be interesting to see how much actual selling by longs, there are not that many of them because the government owns most of them, or shorts pressing against the the BOJ's new target can actually move yields.
Yeah. It's important to realize what actually they have done. All they have done is move the absolute upper band where 10-year notes can trade, 10-year JGB notes can trade from 50 basis points to 100 basis points. But they stress that they can intervene at any level between 50 and 100. That means that what did the market do? The market went to 55, 57 and stopped there because nobody really wants to test the Bank of Japan on the first day because they could intervene at 58, 59, 60, and any point above. So, really trying to sell into the Bank of Japan on the first day is not a very good idea. So, the market response was very muted, but it's yet another indication that the central banks are still moving in the direction of higher rates and probably, higher long-term rates. I completely agree with you that swapped back into local currency, JGBs are probably the cheapest market or the best market to invest. I won't call them cheap.
Right.
But what it does is it removes another reason why anyone sensible would pay the very steeply negative premia in US treasuries unless there is a very good reason to do so.
Right.
And really, next week, we get the really important part of the news. This week, it was for amateurs. Next week is for professionals. What we get next week, to me, is far more important than what we got this week because we knew that the Fed was baked in. We knew that the ECB was baked in. We knew that, or we thought we knew that employment numbers would continue to be strong. Now we get the QRA and the quarterly refunding announcement with the amounts of the deficit and the composition of the coupons that are going to be issued as opposed to bills. What do you think about that? Because this is going to be crucial for all assets going forward.
Right. So old gray beards like Nick and I have been watching the quarterly refunding announcement forever, basically,
Yeah.
because it tells how many US treasuries are going to be auctioned in the next quarter and what the composition is, what maturity they are. It's become the key piece of information in my process to understand how quantitative tightening by the Fed is going to be muted or enhanced. And so the lever that the Treasury has, which because of the way QT works, where the Fed just says we're going to let our bonds mature, the lever has been handed to the Secretary of Treasury to decide how impactful paying back the government will be. And for basically a year now, well, call it 9 months, the Secretary of Treasury, Janet Yellen, has starved the market for long duration Treasury bonds and financed her deficits, the payments, the TGA lately, which is her checking account, using low impact, high liquidity bills issuance. So that may change. And let me tell you why. One, bills are the highest point on the yield curve. So the taxpayer is paying a very high yield when they could pay a lower yield in financing longer term. Two, the government doesn't want to have its balance sheet, its issuance, its debt outstanding heavily in bills. In fact, they have a guideline of between 15 and 20% of outstanding debt to be in bills. Lastly, sort of a combination of those two things, that bills issuance happens in size when the government has a extreme need for money, which in this case has been the TGA, her checking account refill, but in other environments has been during financial crises. And during those financial crises, bills actually have very, very low yields, and treasuries have very, very high yields because the curve is what is called steep. Here, everything's reversed. We're not in a financial crisis. Bills are heavily inverted to bonds, and we're at 20% of outstanding bills relative to the total debt. And so it'll be very important if she shifts from the last 9 months of starving the market for bonds to, doing what is typically normal and issuing about 80% of the deficit in bonds.
Yeah. So on Monday, we get the announcement of the deficit. And on Wednesday, we get the actual amount of coupons that are going to be issued, i.e., the split between bills and coupons. And the market has estimates for all of these. I would have thought that anything around 225 billion worth of coupons is probably priced in at the moment. So really we're looking for an announcement which is over 225 billion worth of coupons to be issued that will move the market one way or the other. Would you agree with that amount? And what do you think the repercussions to the yield curve will be if it's significantly higher than 225 billion?
Sure. So, we'll start with what we're going to get on Monday, and Monday will tell us what the deficit is. And, that could be, it's been running around 1.4 trillion, which would suggest about 360 billion of new bonds to be issued, new obligations to be issued. And they also have quantitative tightening to pay back the Fed, about 180 billion. So sort of roughly on Monday, we should get a new issuance quantity of between 500 billion and let's say the outsize is 650 billion. We'll see what that is. The higher, the worse for bonds, meaning two things. One, it's a lot of issuance. And two, it means it will have to be above the 225 billion that is priced in. So Monday actually has some data to it. The higher that number is, the worse for bonds. And I think any number above, call it 550 billion, is going to be perceived as a bad number. And then on Wednesday, we'll get the composition, and I agree the 225 is sort of what's priced in. But 225 assumes 550. So if 550 is 600, 225 is going to have to be higher than 225. So it'll be an interesting. We'll get the date on Monday, then we'll get the date on Wednesday, and both could have signals. Wednesday will have most likely the bigger signal, and basically, assets haven't performed very well during this period of stocks. AI stocks in particular have done well, but the yield curve has been going. All yields across the curve have been going up for a very long time, and a number above 225 billion of coupons is likely to, modestly above, is likely to continue to put pressure, add the BOJ information as well, continue to put pressure on long-term bond yields, maybe 5-10 basis points. But if you talk about a number, say 275 or 300, at that point, bond yields could really test their highs in the long end. And let me just make one last point on this data. We're running a $1.4 trillion deficit, and the Fed is getting paid back 720 billion a year in QT. That's a $2 trillion number annually, and that's not likely to change in the next 2 years. So when you look at that, that's about 500 billion of financing a quarter. And the government is ultimately going to get to a point where they issue 80%, 20% bills like their guideline, 80% coupon bonds. So the number is heading to 400 billion a quarter, which is a very big number. The question will be how quickly they get from 178 billion last quarter to 400 billion on a run rate basis. So even if the number is 225, we're heading on a path to a much bigger number, and the market may start to wake up to that idea.
Yeah. So really the response that is likely to come from a much higher number than 225 is higher long-term yields and therefore a flattening in the curve, because the short end is very much now anchored by the fact that we are probably approaching terminal. Whether we get one more hike or not is what we're arguing about, and that's 10-15 basis points of wiggle room that we have there, because we're not going to price in 100% likelihood of a Fed hike. That is very unlikely unless we get some very strong economic numbers. And neither are we going to be looking for immediate cuts. Therefore, we know more or less where the 2-year note is going to trade as a range. The question is, where do 10s and 30s, which really impact equities, trade? And if we start getting numbers which are much higher than 225, the yield curve is likely to go less inverted, i.e. the yield of the long-term bonds is likely to go higher, and that's going to compress the multiples, even if the earnings are as expected or better than expected of those equities. So next week is going to be a pivotal week for what happens to bonds, and therefore what happens to equity multiples, and whether we keep our positions or reduce them or change them in any way.
Yes, indeed. And so it sounds like what we need to do is look at these numbers and respond to our clients here at Two Graybeards, and that's what we'll do.
Absolutely. There's no point in deciding to do anything before we've seen the Monday announcement, but more importantly, as you said, the Wednesday announcement. And then we will contact you either by email or do an extra video, depending on how
Absolutely.
important we feel it is that you should be informed about what has just happened, because this next week is going to be very decisive about what happens over the course of the next 3 months, I would say.
Yep.
So now I will go through the portfolio, and there have been really no changes. But as we said, Next week is going to be extremely important and seminal, and we will send you either an email or do an extra episode to keep you fully informed about what the QRA was and what the implications for all assets are.
This sounds great.
Thank you very much indeed. Goodbye. Let's have a look at the portfolio. Well, the only thing that changed this week is that the 440 put we were short of has expired. Worthless, so we've got that money. We're still long of this one 440 call to the 18th of August, and that's good because we have optionality over the QRA announcement. And as we said, these are the approximate allocations of everything, and we will definitely send you an email and or do a extra video after we've seen the composition of the QRA on Wednesday. I can't stress how important we think that is going to be, because it's going to determine whether we keep any bonds, increase the bonds, and what we do with the equities. We might have to transfer everything into commodities and cash, but we will see. As usual, in the broker statement, you have two statements now. You have the statement which shows you the account state, and you have the activity for the whole month, so you don't have to go hunting through the first statement to see anything that was done. As far as orders are concerned, we didn't do anything all week. The low in VWOB was 11 and we were bidding 10. And since next week is going to be so seminal, and actually VWOB goes ex-dividend as well, we've now cancelled that bid, so we have no orders, and we will inform you next week about what we will do. We will definitely do something next week because the QRA is going to be that important. Thank you very much indeed, and have a great weekend.